We're going to have some fun on this one. Cisco's rising after repeating a beat. But get this, he has reported a beat on top and bottom line. Doesn't get the respect from the sell side. But you know who actually buys stock? The buy side. And the stock is moving up. Chuck Robbins, Cisco CEO, joins us now for a first interview. I've got to tell you, Chuck, I have never heard you this exuberant, including things like saying you're the $57 billion in revenue, up 11% year over year, the highest revenue growth in a decade. And how about the fact that you've got this 30% total sequential product line, which is the highest, second highest in 20 years? You came out firing last night.
Well, it's just the facts. So, I mean, but
well,
look,
tell us how the facts happened.
Well, if you think about what's happened over the last year, with our sales organization, when they open a quarter, they give us a forecast. And when things are getting worse, they tend to miss the forecast by the end of the quarter. And this quarter, they opened the forecast, they nailed month one, they nailed month two, and they ran through month three by hundreds of millions of dollars. And, you know, the year-over-years are all wacky because of the pandemic and the supply chain stuff. But the sequentials are what we've been watching. And, you know, normally they're 18 to 20%, and they were in excess of 30% from Q3 to Q4. So it's one quarter, but it was certainly felt better than the ones we've seen in the past.
Well, I like the pastiche of how you did it, including what you're doing with hyperscalers, where, by the way, you have $500 million in sales for what is basically AI. So I think there are a lot of people who feel like you got left behind, including yourself, in the last revolution. That didn't happen this time.
No, the first wave we missed, and we've been very open about missing it. And the last few years we've reinvested. We've built some very high-end silicon that's very energy efficient and super powerful. And so we are well positioned as we enter this next phase, this artificial intelligence phase. We just launched a new ASIC for that in June. We're actually working with a bunch of the hyperscalers. In some cases, they're giving us input on design for the next chip. And in many cases, we're actually talking to them about designing silicon specifically for the customer. So I think we're in good shape.
I also like that was terrific because it's going to be sticky, and also taking share, which I thought was terrific. 3 points. I also like the fact, and you didn't play it up, I would have more, that you're becoming a software company with this recurring revenue, which is what you and I have been talking about for years, and it's fantastic.
Yeah, so we have $35 billion in RPO. And
in English, please.
Run pass option. It's a remaining performance obligation.
I like your wide receivers and I like your running back, but please, let's just keep going.
Remaining performance obligation. So basically, Scott Herron, our CFO, went through on the call. He said between ARR that we can renew, between RPO of $18 billion, almost $18 billion that's already on the books for this fiscal year, and the backlog, we have about 40% of our revenue that's already inside Cisco for the year. And if you go back 7-8 years ago, that wouldn't have been the case. We were trying to chase down orders every quarter to make the quarter. So this software transition has been great. The other data point I gave on the call is we launched in 2017, we launched subscriptions on our networking hardware, which everybody thought was a bit crazy.
Right.
And I always told them when the renewal opportunity for that became meaningful, I would share that with our analysts and shareholders. And yesterday we gave that number for the first time, that this fiscal year we will have close to $1 billion in software renewals on hardware that we would have just monetized one time in the old model. And so, so we're feeling good about that.
Some people thought your guidance was a little light, given
including Jim,
how enthusiastic you were.
Did.
You mentioned it. Given how enthusiastic you were about the pickup in enterprise spending that you're seeing.
Well, look, it was still down 14% year over year, and there are a lot of unknowns and dynamics out in the marketplace right now, and so we took the forecast from the team, we took the backlog, we took the AR, the RPO, and everything like that. We run the P&L. We were probably prudent, is what I would say. But
is that code for conservative? Jim also said that.
We were prudent. We think we were prudent. So, but it's look. There's still a lot of variables, obviously, that are happening in the marketplace right now.
Yeah. What does the macro look like? What do we take away from this as it relates to how companies are feeling about spending?
Well, the good news for us is that it was our largest quarter ever of enterprise software agreements. In large enterprises, we're making big decisions, and I didn't hear much. Well, we're going to hold off on that.
Right.
So that was, service provider remains challenging. the telco space remains very
just
challenging.
call it to see it. Verizon and AT&T are very distinctly hobbled from the old days of Cisco when John Chambers ran it, and that was just kind of money in the bank.
And it was a much larger percentage of our business back then. And today, as you look at the service provider segment for us, the hyperscalers are a very significant percentage of that business now.
Now we're talking about the big guys that everybody knows.
The big cloud providers. And so, they'll continue to spend, and we think sort of the second half of our fiscal year, we think the telcos will stabilize. And then we think in the next few months, we'll start to see the hyperscalers tend to buy in 6-month cycles. So we think sort of middle of our fiscal year, they'll buy for the first half of calendar 25.
Do you think that the hyperscalers actually know what they're going to do with all this equipment that they buy from you when it comes to artificial intelligence?
Oh, yeah. I think they know. Well, I mean, if you look at what they're doing today is that they're building out these AI networks, and fundamentally, these GPUs have to be connected, and they're sharing information, and they have to do it very quickly. And we've talked about the fact that we think the networking opportunity underneath the GPUs could be 3 to 4 times what the original.
This is
cloud
underneath
built up.
NVIDIA. They have to connect it to. They have to connect it to Azure. They have to connect it to Amazon Web Services.
And the historical way of connecting that is through a technology called InfiniBand, and
owned by
NVIDIA. And however, the cloud providers are telling us that they want to ultimately move to Ethernet, and some of them are running some of their fabrics on Ethernet today, which is what we do. And we actually are a founding member of something called the Ultra Ethernet Consortium, which is designed to actually tweak the Ethernet standards a bit. It's a little geeky, but tweak the Ethernet standards a bit to actually make it more adaptable for these super high performance environments.